Welcome back to the Neuro Finance Masterclass. We are officially on day 43 of our 365 Days to Financial Freedom series, and today's theme is an absolutely crucial one, the PE ratio and company valuation. Our main goal in this explainer is to level up your neuro fitness so you're thinking exactly like a Wall Street analyst. We're going to completely dismantle what I like to call the price tag trap. It's this incredibly common, fundamental amateur illusion that trips up so many people in the stock market. Look, if you truly want to act as the architect of your own wealth, you've got to break free from the way everyday consumers look at numbers. We're going to deconstruct how companies are actually valued, so you can literally stop guessing and start analyzing. So let's get right into it.
Right off the bat, here is the fatal flaw in amateur financial thinking. In the world of finance, price and value are entirely different concepts, period. Now, in our day-to-day lives, we are so deeply conditioned to believe that a price tag tells us exactly what an item is worth, right? I mean, if you walk into a store and see one pair of shoes for $200 and another pair for $20, your brain instinctively assumes the $200 pair is just way better quality or far more expensive to make. But here's the thing. The stock market doesn't work like a retail store. Price is just what you pay. Value is what you actually get in return. A stock isn't some static object sitting on a shelf, it's a living, breathing, cash-generating business. And honestly, until you separate these two ideas in your mind, price versus value, the stock market is always going to feel like this chaotic casino instead of the system of profound mathematical logic that it actually is.
Okay, let's dive into this and just completely shatter that illusion right now. When an amateur logs into their brokerage account and sees a stock trading at $10, their immediate, knee-jerk reaction is to label it cheap. They're thinking, awesome, I can buy 100 shares of this. But then, when they see some massive blue-chip stock trading at, say, $1,000 a share, they instantly back away. They get intimidated. They think it's way too expensive simply because they can only afford one or two shares. But that emotional reaction, it is completely false. That $10 stock could very well be the most wildly overpriced, toxic garbage on the market, heading straight to zero. And meanwhile, that $1,000 stock might actually be an absolute, undeniable bargain when you look at the immense amount of cash it's producing. To really grasp why the share price by itself is a completely useless metric, we actually need to leave Wall Street for a second and look at something a bit closer to home.
Section 1. The lemonade stand analogy, a real-world test.
So, picture this. Imagine your neighbor walks up to you and says they want to sell you their thriving neighborhood lemonade stand. The asking price? Exactly $100,000. Now, I want you to just sit with that number for a second. Let it settle in. Is that a cheap deal or a massive ripoff? Well, you can't answer that, can you? It's an impossible question.
And you can't answer it because, as Wall Street architects know perfectly well, you cannot judge a price tag without asking this one absolutely critical question first. How much profit does it make every year? That right there is the engine of the valuation. That's the missing puzzle piece. Without knowing the actual cash that the business generates, the price tag is literally useless information. I mean, you wouldn't buy a car without popping the hood to see if it even has an engine, right? So you definitely shouldn't buy a business without checking its profit.
And this brilliantly illustrates our core concept. Let's say that $100,000 lemonade stand makes $50,000 a year in pure profit. Well, suddenly, buying it is incredibly cheap. Just think about the math for a second. You're making your entire initial investment back in just 2 years. After that, the rest is pure gravy. It's an amazing, life-changing deal. But what if that exact same lemonade stand only brings in $10 a year in profit? In that scenario, it would take you 10,000 years just to break even. That exact same $100,000 price tag just became a ridiculous, overpriced scam. Notice how the price, the $100,000, never changed, but the actual value shifted entirely based on the context of those underlying earnings.
Which brings us to Section 2. Enter the PE ratio, the architect's tool.
This brings us directly to how the pros actually evaluate the stock market. We're essentially taking that simple lemonade stand logic and scaling it all the way up to multi-billion-dollar multinational corporations. Say hello to the PE ratio, which stands for the price-to-earnings ratio. This little formula is basically the ultimate X-ray vision of Wall Street. You calculate it simply by taking the stock price and dividing it by the earnings per share. What this does is it surgically strips away the cosmetic illusion of the stock price and tells you exactly, mathematically, how much you are paying out of your own pocket for every single dollar of a company's profit.
So the crucial point is understanding what this number actually represents in the real world. Let's say you're researching a company and you see a PE ratio of 15. Mathematically, that means you are willing to pay $15 right now for every $1 of profit that the company's generating this year.
You aren't just buying some random piece of paper or a flashy ticker symbol on your phone. You are paying a multiple of the actual tangible cash that business produces. You are literally saying to the market, hey, I will hand you $15 today because I believe in the $1 of profit you're creating.
Moving on to Section 3, Decoding the Metric. Hype versus reality.
So let's look at how this metric categorizes the real businesses you're actually going to encounter out there in the wild. First up, the high PE. If you see a PE of 100 or even 200, you are paying a massive premium. That stock is heavily hyped. Investors are willingly paying $100 for just one single dollar of current profit. Now, why on earth would anyone do that? Well, because they're expecting explosive, massive growth in the future. They're betting that $1 of profit is going to turn into $50 very soon. But remember, this is highly risky. You are essentially pricing in perfection. If that expected growth hits even a tiny speed bump, that stock is going to crash aggressively. Second, we have the low PE, which is typically sitting around 10 to 15. Now, this usually points to a mature, stable company. It's a classic cash cow. It might not be the flashy tech stock making headlines on the evening news, but it's reasonably priced based on the solid, predictable money it's making right now. You are paying a very fair price for a steady stream of income. And finally, the no PE. What happens if a company doesn't even have a PE ratio? That means they're losing money. They literally have zero earnings to divide the price by, so the math just breaks. In this case, you aren't buying a functioning, profitable business, you're buying a dream. You are purely speculating that, hey, maybe one day they'll actually figure out how to turn a profit.
Let's wrap this up with Section 4, your cognitive action plan. All right, we've covered the theory and the math. Now it is time to put this into rigorous practice. This is the empowerment phase of our explainer today. I've got a concrete cognitive task for you to complete right after this to immediately apply your new financial literacy. Here are your 4 steps. Step 1, open up your financial app of choice. Step 2, search for 3 of your favorite companies. Brands you use every day. Maybe the company that made the phone you're holding, or the place where you buy your morning coffee. Now, step 3 is the absolute most important part of this entire exercise. I want you to forcefully ignore the share price. Just totally ignore it. You're going to feel that psychological urge to look at it, to immediately judge whether it's cheap or expensive. Acknowledge that urge and then completely disregard it. We are breaking that old consumer habit right now. The share price is just an arbitrary slice of the pie. It tells you absolutely nothing about how big the actual pie is. Instead, execute step 4. Look specifically for the number labeled P/E ratio and compare them across your 3 chosen companies. Look at the real engine underneath the hood, see who's overhyped, and who is quietly generating cash.
Because this is the new paradigm you're operating in now. Let this really sink in. As an architect, you do not buy prices, you buy profits. This mindset shift is precisely what separates the people who are just blindly gambling in the markets from the people who are actually building systematic generational wealth. You are no longer swayed by flashy price tags. From now on, you demand to see the underlying value.
So the very next time you log into your brokerage account and see some stock-catching headlines flashing green or red across the screen, I want you to take a breath, pause for a second, and ask yourself this one defining question. Are you buying an actual business, or are you just buying a price tag? Master the PE ratio, and you master the game. I will see you tomorrow for day 44. Stay focused and stay wealthy.